Welcome to the Brainless Investor YouTube channel. By the end of this video, you'll understand what's a producer price index, or known as PPI, why it matters, how to calculate it, and how to read the PPI. Now, let's move on to the definition of producer price index, or known as PPI. The PPI gauges inflation at the wholesale level, whereas Consumer Price Index (CPI) reflects the expenses incurred by consumers. The PPI also tracks fluctuations in the prices that local manufacturers earn for their products and services. This index is released on a monthly basis by the Bureau of Labor Statistics. PPI indexes are determined using data related to goods and services in various industries and the economic identity of purchaser, which are utilized to assess the total monthly variations in the final demand of PPI. These indexes track alteration in prices found in private agreements that rely on the input costs of suppliers. The pricing pattern for both producers and consumers are expected to remain aligned, as the costs set by the producers significantly impact the prices that consumer pays. So what's in the PPI and why it matters? What's in the PPI? As we mentioned earlier, the PPI tracks the overall shift in selling prices that local manufacturers earn for their goods over time. The PPI encompasses prices from the initial commercial sales of various products and certain services. Goods producing industries like mining and manufacturing are also included. In the newer version of PPI, it also includes constructions industry. It excludes any imports since those aren't produced domestically. So why it matters? It can predict future consumers' inflations. If the producer faces higher costs, they may pass those on to consumers. Businesses use it to adjust prices or renegotiate contracts. Policymakers and economists use it to assess inflation trends. So now we've understand what's PPI and why it matters. Let's look on how to calculate PPI. First of all, we need to take samples of goods and services. The government surveyed thousands of producers across its industries. They track prices for a fixed set of goods, services over time. Second is base period. The index uses a base year where the PPI is set to 100. Prices change are measured relatively to that base year. For an example, if the PPI for steel is 120, that means the prices are 20% higher than they were in the base year. The third is weighted average. Not all goods services are treated equally. Each item is weighted based on its importance in productions. Heavily used items like oil or lumber affect the index more than less used items. Next is types of indexes. Final demand (PPI) focuses on prices for goods and services sold for personal consumption, capital, investment, export, or government, whereas intermediate demand (PPI) looks at the price for goods sold to businesses for further productions. Now let's understand on how to read the PPI. For an example, the headline number says the PPI for final demand rose 0.4% in March. This shows the monthly change. It may also give the 12-month change, or known as year-over-year. Core PPI exclude food, energy, and trade services, which are very volatile. It's useful for spotting underlying inflation trends. Breakdown by category, you'll see the tables showing changes for specific sectors such as manufacturing, energy, and constructions. It allows the economic to pinpoint which sectors are driven by inflations. Charts and graphs often include visual trends to show whether the producer prices are rising or falling over time. Below shows a simplified version of a PPI table. Before we end this video, let's compare between CPI and PPI. CPI tells you what the consumers are paying. PPI tells you what businesses are charging each other before those goods or services hit the shelves. PPI often affects CPI. If producers face higher costs, consumer might have to pay higher costs too. So consumer price index measures the average change in prices paid by consumers. It is from the buyer's perspective point of view or retail level. It covers things like goods and services like food, housing, and healthcare too. It includes imports products too. It is used to adjust Social Security inflation targeting tool. It's published by U.S. Bureau of Labor Statistics, or known as BLS. It is at the end of the supply chains where consumers purchase the product. It is less volatile and more stable as it's less affected by commodity swings. The core index does not include savings, investments, and spending by foreign investors. It strongly influences on interest rate decisions for monetary policy. PPI measures the average change in prices received by producers. It is from the seller's point of view or at the wholesale levels. It covers raw material, intermediate goods, and finished goods. It does not include any imports products. It only includes domestic productions. It's used for business cost forecasting, early inflation signals. It's published by U.S. Bureau of Labor Statistics, or known as BLS. It is from the start or middle part of the supply chain, which is the production stage. It is more volatile as it is more sensitive to commodity prices hike like oil. The core index excludes food, energy, and trade services. The impact on monetary policy is seen as a leading indicator but less directly used. We hope you enjoyed this video. If you liked it, please leave a thumbs up and subscribe to this YouTube channel.